Well, good afternoon and welcome to HYROX's weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I'm Scott Tomlinson, and my partner and colleague Paul Tepsich, the founder of HYROX, is also with us on the call, as is our financial planner and wealth forecast specialist, Bianca Tomlinson. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Well, let's start with a review of our themes for 2017. We think that our strategy of having a tactical perspective to investing becomes even more important in 2017 because of the even greater levels of uncertainty imposed on us by a number of developing factors. If the new U.S. administration is able to push forward some of its tax proposals and spending initiatives, there is a greater likelihood of inflation, and the expectations surrounding this will change the dynamic in financial markets. To a large degree, bond markets have been showing us this already. Well, higher bond yields and higher short-term rates in the U.S. with 2 or 3 more Fed rate increases this year will increase the cost of borrowing, which in turn could present us with a whole new set of risks with global debt levels at record highs. With improving economic conditions and a lower tax burden, it is expected that earnings will grow at an approximate rate of about 11.5% in 2017. However, this appears to be more than priced into current equity markets at this moment in time. And it remains to be seen how the new populist revolution plays itself out, but Brexit and the Trump presidency, as well as upcoming elections in the Netherlands, France, and Germany, are creating all sorts of uncertainty. So we'll come back to the latest developments on these issues shortly. But why more emphasis on the tactical approach? Well, the old rules for balance and diversification are no longer working in their traditional manner, and long-held relationships between asset classes have been breaking down. And this was an important part of the development of a tactical investing model to complement our fixed income and global equity models. 3 models that we use to get balance in our portfolios allow us to have greater flexibility and depth over the standard buy and hold strategies, and this will be even more important as we structure our investing process for 2017. Well, volatility has picked up in stock markets but remains relatively subdued compared to some of the peaks that we saw last year. However, we know that low volatility inevitably does tend to lead to higher volatility, and we look for opportunities when fear becomes extreme, and it does appear that we are heading in that direction. Well, our global equity benchmark, the All Country World Index ETF, has had an annual average total return of 17.51% over 1 year, 2-year average annual return of 5% over 2 years, a 5.86% average annual return over 3 years, and an 8.9% average annual return over 5 years. The ACWI is weighted heavily toward the U.S. with about 51.5% of the constituents in that index being in the U.S. If you have a fully invested 60% equity portfolio, the exposure would be about 31%, and a 40% equity portfolio would have about 20% U.S. equities. Each country is represented to a smaller degree thereafter, but don't forget that this is it is the companies that are domiciled in these countries that are the underlying investments. Well, our fixed income benchmark Canadian Universal Bond Index, XBB, has had a total annual average return over 1 year of 0.68%. 2 years slightly negative 0.18%, minus 0.18%. Over 3 years, annualized return 3.31%, and over 5 years, a 2.71% annualized average return. When we combine the two benchmarks into a more growth-oriented 60% equity and 40% fixed income portfolio and allow for fees and costs, the 1 year total return has been 9.63%. Now remember, you would have had to start with 100% cash and be fully invested 1 year ago on January 30th, 2016. But if you're already fully invested, we look at the 2 year period, your annualized average total return over those 2 years would have just been 1.83%. Therein lies the argument for a more flexible and tactical portfolio. 3 years, we see a 3.69% return, total return, annualized over and averaged over those 3 years, and a just a little over 5.25% return for 5 years. For a less growth-oriented 40% equity and 60% fixed income portfolio, the 1 year return has been a little over 6.25%. The 2 year return just 0.75%. The 3 years a little over 3%, and the 5 years just a little over 4%. A HIROC client portfolio already invested, but with a higher weighting of cash for the purpose of finding new opportunities over the last year, has had a total return of 8.17%, which is below the benchmark, but the longer-term portfolio from October of 2012 continues to have an advantage over the buy and hold strategy benchmark. We do tend to put significantly more emphasis on longer-term performance than the quarterly or 1 year performance, as it smooths out averages over longer periods of time. Last week on my blog, I pointed out the differences between a 2 year buy and hold portfolio of a non-client who showed me their portfolio summary report, and I compared it to a more tactical HIROC private client. And I posed the question, who would sleep better at night? Well, the non-client decided to become a client. They obviously prefer a better night's sleep. While making comparisons, we also have to look at the risk factor, or the return per unit of risk, which compares apples to apples, so to speak. If we look at the 2 year period for a HIROC private client portfolio over 2015-2016, the return per unit of risk taken is 2.46 times. The benchmark 60% equity, 40% fixed income buy and hold portfolio was only 0.84 times. You can also see the S&P 500 and the TSX have lower return risk relationships. On the chart, this translates into a significantly better return for the amount of risk taken for the HIROC client relative to the benchmark buy and hold strategy. A more tactical approach has also proven to provide better risk-adjusted returns over this period than the buy and hold portfolio. Now, as a reminder, historical returns are no guarantee of future returns, but at HIROC, as you all will know, we work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is crucial that we review your wealth forecast on a regular basis so that we can ensure that your long-term goals are in line with your portfolio strategy and our forecasts for your net worth into the future are up to date. Well, let us turn our attention to what is happening on the inflation front. Commodity prices have stalled somewhat through the beginning of this year, but the latest inflation data show rising consumer prices. Now, the Fed's core PCE price index rose 1.7% through 2016, inching toward their 2% target. And this morning, the euro area data for January showed a marked jump to 1.8%. While the debate continues as to what monetary policy adjustments will follow, no changes are currently anticipated. Last night, the Bank of Japan announced no changes to their existing policy. But as I said before, euro inflation jumped, but when energy is factored out, the core inflation rate remains at less than 1%. As for the impact of rising bond prices on record amounts of global debt, well, in Canada, focus returned to the household debt as the Bank of Canada presented to the House of Commons Standing Committee on Finance yesterday, and has been a continuing concern. High levels of household debt and housing market imbalances could pose significant risk to the financial system if there was a considerable rise in the unemployment rate, whereby indebted households without income would be unable to service their debt. And yesterday, the National Bank of Canada suggested that a 10% border tax from the Trump administration could result in a 9% drop in Canadian exports, which could cause a 1.5% decline in Canadian GDP. That may indeed be a problem for the unemployment rate going forward. Well, as for corporate earnings, it is expected that they should return to growth over the course of the next couple of years, with energy companies rebounding considerably after big declines through 2015 and 2016. However, this is all built into current stock prices, which on a forward price to earnings ratio look as expensive as they were at the beginning of 2015. Another of our metrics of value, enterprise value to EBITDA, also shows stocks to be as expensive as they were at the time of the dot-com bubble. So we think stocks continue to be expensive, especially in the United States. And there's plenty of action on the geopolitical front this week. Keeping in mind the International Monetary Fund's latest analysis, it has raised its forecast for U.S. growth based on the Trump agenda, but has warned that if protectionist trade proposals set off a trade war, it could be quite destructive for the global economy. Well, U.S. policy uncertainty is definitely rising. And U.S. President Donald Trump's top trade advisor this morning accused Germany of bolstering its trade advantage with a grossly undervalued euro, according to the Financial Times. Peter Navarro, the head of the new White House National Trade Council, was quoted as saying that Germany's advantageous trade position within the European Union was the main reason for the demise of the U.S.-EU trade accord known as the Transatlantic Trade and Investment Partnership. And reaction from major American companies to President Trump's order on Friday restricting entry to the United States by citizens of 7 predominantly Muslim nations and all refugees has ranged from silence to outrage. Also, in a phone call with Mr. Trump on Saturday, German Chancellor Merkel objected to the president's temporary ban on the entry of Muslims from the 7 countries. To make her case, the Chancellor's spokesman said Ms. Merkel found herself explaining the Geneva Conventions, which oblige countries to protect refugees of war on humanitarian grounds. However, that did not seem to faze President Trump. And the Justice Department standoff was the latest in a series of extraordinary events. Goldman Sachs Chairman Lloyd Blankfein said that this was not a policy that we support, and now is a fitting time to reflect on those words and the principles that underlie them. At the State Department, employees signed a draft document formally protesting the order, and former President Barack Obama also weighed in for the first time since leaving office. So here at High Rock, with all of the upheaval happening, we will continue to monitor event risk and price valuation, and we will add or reduce holdings in our models as opportunity presents itself, and by preparing our strategies with continued deep levels of research, as we did last year, and keeping in mind that our tactical approach allows us to add value and reduce risk to give us the best possible risk-adjusted returns. And as Paul was mentioning last week, we did some trades in mid-November that involved selling fixed-rate perpetual preferred shares and buying fixed-rate reset preferred shares to coincide with longer-term interest rate adjustments. And we did this for all of our clients simultaneously. And this is just one example of how being tactical can reduce risk and benefit return in a portfolio. And Paul, you've done some more trade yesterday, and maybe you want to talk about a little bit of that.
Sure. Thanks, Scott. We did buy some 10-year Government of Canada bonds back We had paired out of some of our Government of Canada positions back in the fall, starting in early September, in fact. So we did a little bit of buying back, and part of the reason why was, number one, we think the stock market, the risk markets, like the stock markets, are a little toppy here. We did pop through on 20,000 on the Dow, and I think everybody got all overly excited. And it's nothing more than just a psychological level. And we feel like there's a bit of a move coming in the bond market to higher prices, lower yields right now, which we certainly saw today. But as you can see in this chart, and what this chart shows is in white is the Toronto Stock Exchange TSX index, the composite index, and in green on the top is the 10-year Government of Canada bond yield. And then the bottom half of the chart shows the correlation between those two, between the TSX and the 10-year Canada. When it dips down and gets red, as you saw earlier this year, back in 2015 and 2013, that means the correlation is moving closer to 1, i.e. it's not behaving the way it would normally behave. Typically, when stocks go up, bond prices go down and yields go up. But what we've seen over the past week or so is that the correlation is starting to come back to a more normalized correlation. So as it moves into the green zone, it's more positive. And if we feel like stocks are toppy and are going to sell off, then we think bonds will perform better, as they normally should most of the time, as you can see in green. So what we did yesterday was buying some 10-year Canadas. Effectively, we're buying cheap protection to our overall portfolios. So that's a long-winded explanation of how we protect it. We're trying to protect the portfolios a little bit here, and I think it's a good time to do so. That's it, Scott.
Thanks, Paul. That's great. And as all our clients know, that this is how we do find ways to adjust the strategy in order to keep our risk levels as low as we possibly can. But of course, it is a very tactical type strategy. It's something that you don't get when you just sit on a buy and hold type portfolio. All right. Well, that's it for today. And as always, we want to thank you all for taking the time out of your busy schedules to be with us. If you have any questions or concerns, we would like you to feel free to email them to us. We will certainly be back with our next update next Tuesday, but until then, this is Scott Tomlinson, and on behalf of my colleagues Paul and Bianca, we want to wish you all a fantastic week.